Hi everybody, good afternoon. I'm Joe Marinucci. I'm the CEO and co-founder of Digital Media Solutions. The business, there we go, right there. The business was founded in 2012, so it's been 10 years. This is our first year presenting at NobleCon, so excited to be here, present to you all today. Also grateful for the opportunity. We are a performance-based digital marketing company, as I said, founded 10 years ago. The difference between digital performance marketing and traditional advertising is pretty simple. We get paid to perform. So what I like to say is we're delivering customers to our advertising clients. We do this off the back of our proprietary tool set, which is talked about on this slide, but I'll go into more greater detail on that as we get a little further into the presentation, albeit short today. That's our first-party data asset, our proprietary technology, and our expansive media reach. Last year's financial performance, GAAP revenue of $428 million, $58 million in adjusted EBITDA. The margins are there. We issued guidance this year on March 14th of GAAP revenue of $465 to $475 million in revenue and $55 to $60 million of EBITDA. There's some data later in the presentation, which you all have in front of you, on the total addressable market. It's big. There's a lot of white space for us to grow into, is I guess what I'd like you to hear me say. So the TAM last year was estimated at $211 billion, growing to an estimated $240 billion this year, growing at, I believe, about a 17% CAGR going out into the future. So, there's a lot of opportunity for us to continue to grow. We're a data-first business. Flywheel is a term that we like to use, and the reason for that is the way that advertising works is, for us, the more we interact with consumers at the tip of the spear, so to speak, by serving ads, the more those consumers interact with the ads and then interact with our owned and operated websites, which we'll get into that too. The more interaction we have with consumers, the more we learn about consumers. We log those interactions inside of our data warehouse. We use them as insights that allow us to make smarter decisions as we go forward. Later in the deck, there's a more holistic view of the ecosystem here, but we always talk about the data flywheel because as you spend in the ecosystem and you interact with more consumers, you acquire more data, you get that virtuous flywheel effect, which is why scaled spend is also on here. The other aspect that we'll talk about is dynamic diversification, which the business is a vertical agnostic, channel agnostic business. We'll get into some splits on revenue in a little bit. So you'll see a concentration in insurance. But when we started the business 10 years ago, we built it, or we purposely built it to be a vertical agnostic, channel agnostic business, to be agile and nimble, and to be able to serve advertiser needs in different end markets. And it's still very much true this day. It's just organically grown into the insurance segment, and that has become a meaningful area of focus for us, but we'll talk more about that. Customer acquisition, the way that we look at it, with the engagements that we have with our advertising clients, we're getting paid to deliver customers. So the funnel you see here is depicting a number of different activities. Where's my, oh, you can't really see it. But at the very top up here, where it says branding, you got these gray areas, those would be more associated with what I would call traditional advertising agencies. And those are areas that we're not taking engagements on with our advertising clients. We're focused on the bottom, where you see things like CPC, CPL, CPT, CPA, and then at the very bottom, cost per sale. This is all being backed into a CAC, cost to acquire a customer, which is a percentage of the LTV. So, I don't want to get into too much vernacular here, but again, we're getting paid to acquire the customer. We're being given a KPI, and we're working against it. And that's why the solution has scaled. We'll talk a little bit more about that. So this is more of a holistic view of how the ecosystem works. And again, I think Tom handed out some presentations, and if you didn't get one, they're in the back, so you all have a takeaway on this. But it starts with data up top, and the data is what is going to drive our decisioning on who we're going to serve an ad to and what that ad's going to say. Consumers would see these ads, they interact with these ads depending on which solution we're deploying, which could be a marketplace solution, could be a brand direct solution. Just a quick minute on that, maybe less. Marketplace solutions, pretty common. They're out there. Consumers are price shopping for products and services that are largely commoditized. Travel, hospitality, insurance, consumer finance, these are all segments of the market that benefit from marketplace solutions. They benefit consumers because they get to price shop. They benefit advertisers because they bid on consumers. So we deploy marketplace solutions in a number of different verticals. So when we're leveraging data to serve ads, you might see an ad for one of our marketplace solutions, which would be Protect.com, and the relevancy of that ad might be you're in a 6-month cycle on your auto insurance policy and you're up for renewal and you're price shopping. So we're going to leverage data to serve an ad. The ad might feature Protect.com. As a result of seeing the ad and having intent to interact, you would click on the ad. Once you wind up on our owned and operated website, you're moving through what we would call a customer journey, which is similar with our business as with our competitors. Our proprietary technology is working in the background of this, and depending on the information that we're getting from the consumer during that journey will depend on how we interact with the consumer. We might ask the consumer to call us. They may call us. We might engage our call center to have a conversation with them. Depending on how that conversation goes, we may then warm transfer them to one of our advertising clients, which would be an insurance company. There's a number of different end results here. It starts with data. We deploy the solutions, whether they be marketplace or brand direct. I'll touch on brand direct too in a second. Technology moves in the background. We decision how the consumer moves through that journey based on the information they're giving us. Ultimately, it terminates with us getting that consumer over to the advertiser where they need to convert into customers. Historically, we've been able to do this, which is why the business is scaled and which is why we basically, you'll see a slide on this. If you look at our top 20 customers, our retention rates are 100%, and we've seen pretty substantial growth amongst the top 20 customers. It's a pretty simple slide. I'd focus on the 4 R's, which right message, right person, right place, right time. It's all about intent, and that's what really creates value in the ecosystem. You think about friction, if you're seeing irrelevant ads or you're just wondering why this, you live in a condo and you're getting ads for lawnmowers might be an example. The irrelevancy of that is friction in the ecosystem. So when we say 4 R's, what we're trying to do is pull friction out of the ecosystem, which we need to do that because we're getting paid to perform, and if you're getting paid to deliver customers, there's got to be intent that you're matching up with the advertising offer. And the only way to do that is to be able to execute on the 4 R's, and that tracks back to, on the very first slide, data technology and media reach, which is again on this slide. Scalable Solutions talks about some of the verticals here. So insurance is our biggest vertical, last year representing 58% of our revenue, followed by e-commerce, consumer finance, career and education, and home services. This slide talks a little bit about those customer retention metrics that I gave you. So we've not only retained 100% of the top 20 customers, we've seen pretty demonstrable growth in there. You've got some pretty big names in there, companies like Allstate, State Farm. As they scale spend, they're leveraging us to help them scale that spend. They very much view us as a global solutions provider. This is getting into more specific data on the breakup of revenue by vertical, and then looking at insurance. So when you look at insurance for the entire year, you'll see property and casualty, specifically automotive, at almost 60%. That diversified as we moved later into the year. We had an acquisition that we were able to execute on last year at the very beginning of Q1. We acquired a company in the healthcare space, and that was very strategic for us because the prior year in 2020 we saw very demonstrable organic growth in the healthcare segment of our insurance business. The organic growth in 2020 in that segment was very high. It was almost 300%. So as part of our strategic plan, we wanted to double down in areas of the business where we were seeing that type of growth, and we had identified an opportunity to get a segment of the curve via M&A and accelerate further up it in the health insurance vertical. So we announced the acquisition of CRISP on, I believe it was April 1st, 2021. Because of that, during the open enrollment periods, in the Q4 period specifically, we saw a pretty big shift in the revenue inside of the insurance vertical. So if you look at the Q4 period, what you would see is automotive dropping down to 49% and healthcare or health insurance sitting at 41%, and then life and home equally splitting the balance of what remained, about 5% each. So again, as we continue to grow, we continue to see diversification inside of the insurance vertical, broken out between mainly property and casualty and automotive, followed by health, and then you have life and home behind that. So we talked a little bit about dynamic diversification on the front end from a vertical perspective. If you think about it on the backside, so from a channel perspective of where we actually deploy our media dollars, we very much view ourselves as being diversified there too. In fact, we purposely built the business to be vertical agnostic and channel agnostic. One of the reasons why we're so successful at that tracks back to leveraging the first-party data asset, which is proprietary, so we don't have any noticeable dependency on any one channel. We're very much agnostic. We deploy our media dollars as we see fit, where we can get the best match between the advertiser and the consumer, so matching up ad demand with intent, while also obviously looking to be able to generate margin and profitability for the business. But again, the main message here is we're not overly dependent on any one of these channels, so not overly dependent on search. In fact, we have virtually no dependency on the SEO channel, so if there was to be an organic algorithm change, it would not have any real negative impact in our ecosystem. So growth drivers. There's a slide coming on the total addressable market here. So generally, the tailwinds that exist with the digital transformation of ad spend, they continue to be there. The TAM last year was $211 billion. This year it's estimated, as I said, at $240 billion, continuing to grow out. Information on that in the deck, and there's a slide coming, but we just have general industry dynamics working for us. We have good tailwinds. So inside of that, we have very specific strategic initiatives that are going to help us grow the business. So we look at growth within existing markets. So if you think about what I was talking about with health insurance, we saw almost 300% growth in 2020. We saw similar growth in 2021. Some of that came to us via the acquisition. So we're going to continue to double down in areas where we're having a lot of success, insurance being one of them. Entering new markets, because it is a vertical agnostic, channel agnostic business, we can leverage the tool set, which sits up top, data technology and media reach, to go into new markets. So we look at areas that we have a toehold in, like a home services, which kind of, I guess, floats between existing and untapped markets. But there's opportunities in new markets for us. And then, for us to grow internationally has been on the radar, although there is a tremendous amount of opportunity for us in the U.S. We certainly look at the international markets as another opportunity for us. Investing in people, process, and technology. This is something we talk about. If you ever listen to any of our earnings calls, we talk about people, process, and technology quite regularly. So continuing to invest in technology at the bottom of this is pretty important, because we view the continued success of the business being very dependent on our ability to leverage data. And we always talk about the rocks that drive growth in our business, and our signals campaign, which is basically the growth of leveraging our data asset, continues to sit at the top of that. So continuing to invest in technology is critical to us, but people and process are there as well. That is also a very circular ecosystem. You can't have one without the other. Executing on accretive M&A. So I already talked a little bit about one of the acquisitions we did last year in CRISP. We have a demonstrated proficiency going back many years on being able to leverage M&A as an accelerator of organic growth. This proficiency goes back to 2016. We took on a private equity investor in the minority that brought in the proficiency and basically embedded it into our culture. So we don't have to grow via M&A to grow, but M&A is certainly an accelerator, and having the proficiency, having the process in place to be able to go out and source deals certainly will help us in the future, because the digital performance marketing space is a fragmented space, so there are quite a few opportunities out there, and we have seen accelerated growth off the back of M&A in the past, so it's an opportunity for us in the future as well. The business mix, so I think this is where I'll touch a little bit on the brand direct side, because as you can see in the wheel up here, I'll try to use the marketplace solutions over here. We're competing with LendingTree, EverQuote, QuinStreet, eHealth. LendingTree had coined that phrase quite some time ago: when banks compete, you win. Hence the marketplace. So on the brand direct side, the business is a little bit different. Marketplace is one-to-one. Marketplace is going to be one-to-many, one consumer, many advertising brands. And on the brand direct side, it's more one-to-one. So we have a lot of engagements where consumers are not price shopping. So if you take e-commerce, for example, you have one advertiser, one consumer, and we're matching up that advertiser's product or service with that consumer based on the data asset that we have and the intent we've seen by that consumer and propensity to transact. So it's very much a one-to-one relationship, and it'll be branded on behalf of the advertiser. We do this in a number of different verticals. E-commerce would probably be the most predominant. But we also, as a subcategory of e-commerce, do work in the charitable giving space. We work with some of the larger charities who have gone to the sustained donor giving model, so effectively an e-commerce transaction, if you will. But again, a very bespoke offering, because you have to have a connection with the charity, like American Cancer Society and Save the Children. So we would leverage our data, our technology, our media reach. We would go out there, we would place ads that would feature those charities. We'd leverage the intent signals that we see to make a connection between the consumer and the advertiser, which in this instance would be the charity, to generate a transaction, which would be the sustained donor. So the brand direct side of the business is a little bit different from the marketplace side in that it's a one-to-one solution as opposed to a one-to-many solution. But again, everything we're doing here, whether it's on the marketplace side or the brand direct side, it's done on a performance basis. So we're effectively being paid, no matter what the solution, brand direct or marketplace, to deliver the customer. Highlights some of the M&A work that we've done over the years, going back to 2015. As I said, we've been quite active from an M&A perspective behind our organic growth initiatives. This is the slide on the TAM that I've been pulling data from. You can see the CAGR at 17% there in the upper right. Again, a lot of white space for us to grow. Strong tailwinds here. And historically, these numbers have been low, and when they true up, they come in higher, is what we've seen. So we're pretty excited about just the organic growth opportunities that allow us to just capture more white space. So insurance is an area of meaningful focus for us, with it at 58% of the business. The digital transformation of ad spend and insurance, depending on what data set you look at, sometimes you'll come across information that says the insurance industry generally is a little bit behind with regard to digital transformation of ad spend. That likely has something to do with the fact that it's now the majority of our revenue, and we continue to see pretty demonstrable growth opportunities there, as I highlighted in the beginning when I talked about the growth in our health insurance business last year at almost 300%. So we continue to see a lot of opportunity for us in insurance. One item of note is in the property and casualty segment of the market, because of increasing loss ratios, the insurers changed their models last year, meaning because loss ratios went up, lifetime values came down, so the CACs got adjusted a little bit. So the totality of spend didn't really move. It was more a function of how that spend got deployed. So that did have some pressure specifically in our ecosystem, in our space with some of our peers. And we certainly saw some negative effects from that as well. But we do believe that there will be a recovery there in the third quarter this year, which is general industry information that's out there. But we remain very bullish on the insurance segment of the market in property and casualty and in health. Other segments of the business, all growing: e-commerce, consumer finance, career and education. This all goes back to what we were talking about in the beginning, which is it's a vertical agnostic, channel agnostic business. We're leveraging that centralized toolbox of data, technology, and media reach, which allows us to move in and out of these different verticals and capitalize on different trends with ad spend. So we got about 5 minutes left now. The rest of this is our financial information. It's in the deck, which is available for you all to take. So I think at this point, I'm going to open it up for Q&A. Go back up to the top. Here we go.
Not quite sure the question. What if anything limits your growth? If your aggressive numbers go higher, I don't that. Manpower, sales and marketing?
You know, it's a combination of, I mean, obviously those things would limit growth, right? So, you know, our sales organization runs top down from our chief revenue officer, so there certainly is a need for that organization to grow as the business grows, because they can only deal with so many opportunities if they're of a certain size and scale, and until they get bigger, they're not going to be able to take on an infinite number of opportunities. But what I will say is, if you look at our top 20 advertisers, they account for about 60% of our revenue, and they're growing pretty demonstrably, so a lot of that effort's already been put forth. You know, the main items that would limit growth would be more on the demand side, our ability to continue to be able to source media at margins that are supportive of operating a healthy business, being able to continue to leverage the data asset, which means we have to continue to invest in people, process, and technology, specifically around the data asset inside of the business, because we're going to continue to leverage that. So staying on the front side of the wave there, looking at everything that is available to us, not only from a business intelligence perspective, but also, you know, as AI becomes more and more, I would say, commercially viable in terms of how we leverage data, we have to continue to invest there. So if we were not to continue to invest there, which we are continuing to invest there, that could be a pretty significant growth limiter, because it could put us behind the curve on our ability to source media.
Maybe one thing I want to add to that is, you know, Joe has spoken about the diversification, the dynamic diversification. And that's a very important concept here, because, you know, we have a number of different sectors where we have presence. And so auto insurance right now is going through kind of a down sector, which limited the growth of a lot of our peers, and to some extent limited our growth, but much lesser extent, because we're very well diversified. So when auto insurance wasn't performing as well, we had health insurance that was doing great, e-commerce that was doing great.
Do you want me to a singular revenue share transaction process?
Sure. So an example would be, you're asking me, how do we generate our revenue? So if you go on right, so take Save the Children as an example, who's an e-commerce customer, subcategory of charitable giving. So we do work on behalf of Save the Children. We will operate digital assets, owned and operated websites that feature Save the Children. In fact, I believe we actually operate a microsite for Save the Children specifically for the transactions that we originate for them. So we'll go out, we'll place ads that feature Save the Children and their cause. Consumer will interact with the ad, will land on the microsite. They will fill out the forms on the microsite. If they transact on the microsite, at the point in time where there's a transaction, we have an agreement with Save the Children that every time we deliver them a customer in the form of that transaction, we would get paid. So we get paid from Save the Children. And the consumer would have interacted with Save the Children. As a result of becoming a Save the Children customer, Save the Children would have paid us. They have a lifetime value model. They have a CAC against that. They will effectively allocate the CAC to us. We'll be contracted on that, and we will get paid for originating that customer.
But do you get paid off of the customer, or do you get paid off of what the customer spends?
We're getting paid. Are you asking me No, we're not getting paid off what well, I guess we're getting paid for the customer to transact with the advertiser. So another example would be in insurance, we're not getting paid as a result of, we're not getting paid a percentage of the policy that's being written on the property and casualty side by, say, like Allstate as an example. Allstate's paying us to help them originate the customer, and they have their internal model, and they have, again, a lifetime value and a CAC, and they're effectively allocating the CAC to us to go out and provide them with a deliverable. The deliverable with Allstate's not the customer. It's going to be a highly qualified lead or call that they then take, and their licensed insurance agent will provide quoting data to and effectively write the policy. So there's a conversion there, but ultimately the work that we're being gauged against is our leads and calls converting into customers. If yes, they will continue to spend with us. And Allstate, or in that example, has been a customer for quite some time, and they've been scaling spend over many, many years.
So in that regard, I mean, if you have a customer that's really aggressive and trying to bring customers in, it makes your job a lot easier, but if they're not offering a competitive product or service, then that accrues to you don't make as much money, even though it's not you're still delivering the same. You've done your job advertising, delivering the customer in, but if they don't convert, that affects your revenue.
That's correct, and that's one of the reasons why you see the insurance segment being such a big portion of revenue, because they have customer churn issues there that result in them having to spend to offset churn, and this is in many industries. So, you know, we gravitate to those areas where advertisers have those challenges, and we become a solutions provider to help them offset customer churn. I was just given the "it's over" sign. I appreciate everybody's time today. It was a real pleasure being here at the Noble Conference for the first time.